Hello tradeologists, and welcome to Module 11. In Module 11 we're going to talk about advanced techniques and explosive wealth building strategies. And these are the strategies that if you have a little bit more capital, you can put that capital to use really productively. I'm going to show you a couple of methods that are, just explosive strategies. They really are the way to create wealth in the market, and if you really want to make a killing in the market, this is exactly how the big players do it, and you're not going to find a better strategy than this. Now we're going to talk about a couple of different things. There's some basic strategies that I want to go over, and then we're going to talk about adjusting those strategies just like we did with the option strategies and the monthly income strategies. But this particular module on advanced techniques and wealth building is going to be on stocks. Now, can we substitute stocks and use options instead of stocks? We're going to talk about that a little bit as well. We're going to talk about strategies to not only protect your investments but also benefit from those those strategies of protecting your investments. How to pick stocks. And then we're going to get into a couple of advanced strategies that I really find helpful for the times when you're not really sure if you want to buy stocks or if you want to sell stocks or what you want to do in the market. There's a lot of uncertainty in the market at times, and you don't know if you should be jumping into stocks or not jumping into stocks and so forth. So we're going to talk about a couple of those strategies. But first I want to talk to you, the very first strategy I want to talk to you about is a method that turned a $14,000 trade into $75,000 in profits in about 8 months. And there's a couple, and that particular strategy was some time ago. There's a couple of strategies that I did recently on a couple of different stocks that produced very, very good returns. And once again, this particular strategy does not depend on the stock going up. The stock can actually go up or down. I'm going to show you two examples of stocks that had actually gone in an upward direction, and then I'm going to show you an example of a stock that went in a downward direction and was still able to make money. The key here is to understand the management of risk. Just like we did with monthly income trades, management of risk is everything in the market. You can't have a free lunch in the market. There's just no such thing. Nobody's going to give you a dime. Nobody's going to help you with anything. No one is going to give you a penny that you have not earned. And if you understand that, and then you understand the fact that you have to manage your risk, and also that adjustments are probably going to be necessary. Active management of your trades is a key requirement. Now, your monthly income trades, yeah, you could probably let those go for a while, a review of those every 15 minutes or so, and you'll be fine. The same thing goes for these trades, only there's a couple of different parameters that you really need to take a look at. There's a couple of things that really would trigger your additional action. And we'll kind of go through those. I'm going to set up the basic strategy for you, and then we're going to go into the advanced strategies, and I'm going to try to layer those as we go along so that one piece of knowledge that you have builds upon the next piece of knowledge, so that when you end this particular module, you have all of the pieces together in a coherent whole that you can kind of take with you as you study the market and try to pick stocks that you're interested in purchasing. Now, why do we do stocks instead of options? Well, let me go through the basic strategy, and I think the reason that we do stocks over options in this particular strategy is going to become evident. Number one is these are a little bit longer term trades. I mean, on a very basic level, a lot of times these trades will last a month, 2 months, 3 months, sometimes as much as 8 months or more. And in those cases, sometimes you can't find those long-term options. You can do leaps, but they still have the downside is that they're going to expire at some time in the future. If you buy a stock, it's not going to expire in the future. So the very basic strategy that we're going to start with is actually the purchase of stock. Now, right now I have on the screen a chart of Starbucks going back about 5 years on a daily basis. As you can see, I mean, Starbucks had a tremendous run up here, and then in late 2006 it got into trouble, and it dropped from a high of about $40 a share all the way down to 15.5 just recently. Now, that's a pretty steep decline for this stock. And if you go back, I mean, to a number of different types of stocks, you'll see the zigzag pattern of, you know, a nice run up in the stock, and then, you know, a little bit of a sell-off here. I mean, this is a pretty steep sell-off alone, just going from around 39 down to 28 or so. I mean, that is a pretty bad decline. However, as it climbed back up, and let's take the guy who bought it right here at 40. I mean, you know, right here, right at the tip of that little candlestick right there. Somebody sold it, and somebody bought it right at 40. If you can just kind of take a look at that. Let me draw an oval around that. Right there. Imagine being the buyer of that at 40. That doesn't look good, does it? That stock immediately, the person who bought that at 40 immediately the next day woke up and saw it trading at 37.5 all the way down to 36.5. That's a pretty steep decline for the first day of trading after you bought that stock. Now, would he have any indication that it would probably trade that low? Not really. I mean, if you look at volume, if you take a look at volume, if you have any, I mean, if there's technical analysis involved in the picking of stocks, you would have looked at an increase in volume over this period of time here, this little run up. You know, it wasn't huge, but at least on the day that you bought it, it was huge. There were a lot of people who bought that stock at 40. You know, you would have had no indication that maybe that stock was going to open up dramatically lower the next day. You would have gotten crushed. Now, generally, I go in and I buy 1,000 shares at a time of the stock that I want. Now, you could go in and buy 100 shares, or 200 shares, or 300 shares, or 400 shares. The strategy that I'm going to talk about, you really can't do for less than 100 shares. You need to buy at least 100 shares of the stock. So 100 shares of Starbucks at $40 would have cost you approximately $4,000. Now, on margin, that means putting up about $2,000 in margin. So you've got 100 shares of stock at $40. The next morning you wake up and it's trading around 37. You just lost $100 a share, $3 a share for each $3 for each share that you purchase. So you just lost $300. If you bought 1,000 shares, you would have lost about $3,000. So that's not a very particularly attractive thing to have happen. I mean, if people who bought down here, they're pretty happy. They bought around $29. Now they're up around 40. But there's not very many people that can actually pick tops or bottoms of stocks. Any time that you buy a stock, and it doesn't matter what the price is or what the former chart history looks like, I don't care where you bought it, you're taking a risk. If you just go out and buy the stock and you have absolutely no way of hedging that position, protecting your position, you just go out and buy stock. Now, a lot of people say, oh, yeah, buy stock, and it's a great strategy if you want to increase your wealth. But you know what? You have to be terribly lucky. Now, here's another instance right here. People bought this stock at 32. There were people, I'm sure, that bought right there. Maybe a lot of people. And look what happened over the period of the next month. It dropped from 32 down to 24. Now, it never got back up to there. I mean, well, it did get back up to there, but I mean, it had a little bit of a rally here. It came up to 27.5. But, eventually, I mean, if you waited long enough, you would have gotten your money back up here, which was in December. If you bought this back at the end of 2005, and you're waiting for that stock to get back up to where you bought it, you would have had to wait almost a year just to break even. There's got to be a better way to do it, right? There's got to be a better way to buy stocks and not wait a year just to break even. That's not only a waste of capital, it's a waste of time, and it's not a very smart investment. So what most professionals do, and now a lot of the times this type of a strategy that I'm going to introduce you to is not particularly, I mean, it's not a real big secret or anything, but the actual strategy that I'm going to teach you in initiating positions is rather different than what maybe anyone else I have ever heard talk about. There's a lot of guys who have, I mean, if you work for a large corporation, especially, I'm talking specifically about a public traded corporation. You may have a lot of stock options, or you may have stock that was given to you as part of your retirement program or an incentive program of some sort. I can imagine that companies like Enron and WorldCom years ago that were high flyers, that were trading, for, lots of money, and a lot of the people who worked for Enron and WorldCom had maybe even their life savings into the stocks at those times. Well, if you have stock in a publicly traded company because you work there, and it was given to you as an incentive, or is it given to you as bonuses or something like that, if you're holding that stock and it comprises the majority of your, retirement or wealth in that company, let's think about some other companies recently that have really hit on some hard time. Let's take Lehman, for example. Just imagine working at Lehman Brothers and, having the stock up here at $85. Now, I bet a lot of the senior executives at Lehman and a lot of middle management even had a number of opportunities to purchase shares of the stock at different times at pretty reasonable prices, and maybe they were even bonused stock, back when it was down around $27, $25. It hit $85, and what's it selling for now? $23. If you were working for Lehman Brothers at the time, and you saw the stock up around $85, and you did absolutely nothing to protect your investment, you would have seen it, cut by 2/3 today. That's a pretty tough way to wake up in the morning to see that your stock is down another almost $7. It's a very, very, very tough thing to see. Yesterday it was trading at 35. Now it's trading at 23. That's a $12 decline in the stock. So, that is that's pretty rough. That's very rough. Well, maybe it was last week it was 35, but now it's at 23, and things get pretty bad very quickly with stocks. Now, I've told you, and I mentioned throughout this course, that it's very, 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 very difficult to predict stocks. There are probably 1% of the entire population in the world that can actually predict with any degree of accuracy the future value of a stock. There's got to be a better way, and there is a better way. Let's go back to Starbucks here for a second. I would imagine that even the people at Starbucks have stock. They have either incentivized stock, or they had some, a share purchase plan or something, some other benefit that they had that allowed them to purchase stock over time. Now, people bought it back at $12, just thinking, well, it's still $18. Hey, it's not too bad because they're still up $6. Well, that was 5 years ago. And, if I bought stock at $12 and 5 years later it's only $18, that's not a particularly good rate of return. When it was up around 40, what were they thinking? Oh, yeah, this thing's going to go to 100. They're thinking their stock is going to continue up. But the fact is, we can't predict the future. We can't predict what stocks are going to do. The only thing we can do is manage risk. and we can benefit and profit from the management of risk. The most common form of managing risk is simply to use options to protect your stocks. So in other words, let's say we go into Starbucks right now, and let's say we wanted to purchase 1,000 shares. Well, if we took a look at 1,000 shares of Starbucks right now, it's trading at $18, it would cost us approximately $18,000. Not including commissions. Our commissions would be about $15, and with the shares trading at $18.01, it would cost us $18,000 or $9,000 in margin in order to purchase 1,000 shares of the stock. Well, what does that do for us? Let's go to our analysis tab here for a second, and let's take a look at exactly what this would do for us. Well, if we had 1,000 shares of Starbucks, immediately you can begin to see, and let me just set these up. If it goes up $2, you made $2,000. If it goes up $5, you made $5,000. You make $1,000 for every dollar that the stock goes up. On the other hand, if the stock drops to $16, which is $2 lower, you lose $2,000. If it drops $5, you lose $5,000. Now that's not a particularly attractive scenario. Let's go back to our trade tab for a second. The Thinkorswim platform allows you to actually do something quite interesting. There's a couple different number of trades that you can select when you right-click on any of the option symbols. Now, the most common way that you would be able to protect your stock holding is to simply buy a put in order to protect your holdings. But there's a variety of different put options in order to protect your stock investment. How do you know which one to select? Well, the analysis tab actually helps us to do that quite efficiently. However, there's a couple of different reasons why you don't want to rely on the analysis tool alone, and also you want to use some common sense. And there's a couple of strategies I'm going to describe that allow you, in the purpose of the selection process and the goal of the selection process, is to actually get the stock to prove itself before you make a large investment, before you either continue with the investment or to protect your initial investment when you set it up. And let me explain what I mean by that. Okay, on the surface, you may believe that with the stock selling at $18 and you were to purchase 1,000 shares of that stock, you would want to buy a put. Now, a put would allow you to profit from the stock if it declines. So, placing a put on a stock that you own is probably a fairly good investment. Let's just take a look at a second. We already have in our Analyze tab, we have 1,000 shares of Starbucks at $18.01. Let's go back to our Trade tab and select the 17.5 strike price put. If we wanted to buy a put on Starbucks in order to profit when it goes down, we would select that. Now, one contract of the July 08 17.5 puts would cost us approximately $60, which is, if the price of the put is 60 cents times one contract times 100 shares of stock, because each contract represents 100 shares of stock. If we confirm and send that, we'll see that it costs us $60. In order to protect all 1,000 shares of our stock, then, we need to select 10 contracts. 10 contracts at 60 cents will be $600. And that would be the cost of the investment in order to protect our 1,000 shares. Let's analyze this and see what it does to our profit graph. You could say, well, why would you spend $600 to protect your shares? Doesn't it limit your upside potential? It does a little bit. Let's take this off for a second. you can see if the stock rises by $2 to $20, you make a $2,000 profit. If you add the insurance, your profit is only $1,518. So it does limit your upside potential, but not dramatically. If the stock continues to rise, you make unlimited profits. This is basically what you're doing is providing insurance for your stock. Think about it just for a second. You've got an investment here of $18 a share times 1,000 shares. That's an $18,000 investment. If you were to use that $18,000 in the marketplace to buy anything else, let's take for an example a car. If you took that $18,000 in cash and went out and bought a car, wouldn't it make sense to buy insurance on that car? In other words, if you got in an accident with that car that cost you $18,000, your loss would be total if you didn't have any insurance. So the cost of the insurance, even though you may not use it, certainly would pay off if the stock declined or the car got in an accident. The amount of insurance that you're going to pay is based on the value of the car, your driving record, and some other factors. In a stock, the only thing that you would be able to determine is actually how much insurance you actually want. Now, in this case, we're covering the 1,000 shares of stock with exactly an equivalent of 10 contracts or 1,000 shares protection of the stock with a put option. A put option will increase in price as the stock moves lower. Now, we could have selected other contracts. We could have selected the June contract, for example. The June contract they don't trade the 17.5 put. However, we could select the $18 put, which is the current price of the stock. That would give us even more protection. For example, let's just bring this up. We'll go ahead and analyze that as a duplicate trade. We'll take off the July one just for a second. You can see as we run our cursor over here, our maximum loss on this particular position, if we bought 1,000 shares of Starbucks stock, is only $410. That's with the $18 put for the June expiration. With the July expiration, we have a maximum loss of $1,110. Why the difference? Well, number one is we're using the 17.5 strike instead of the 18 strike, but also the 17.5 strike is a little bit more expensive. It's 60 cents instead of 40 cents. So if the June option at $18 provided us with more protection and it was cheaper, why not use that? Well, the reason is that you're paying for only 8 days of protection. There's only 8 days left until the June expiration of these options. Once these options expire in 8 days, we have no more protection left. So we're going to eliminate that as a potential for protecting our stock. We don't want to pay 40 cents for 8 days of protection. Instead, we would use the July options, which would give us 36 days of protection. That's quite a bit of a difference, even though we're paying 20 cents more for that option. Now, the July options do not have an $18 strike price. They have a $17.50 and they have a $19 strike price. So our options are limited. We can't go to the $18 strike price. We can only go to one of the strike prices that are available in the option chain. If we go back to our Analyze tab for a second, and we decided that, yes, we're going to buy 1,000 shares of Starbucks stock at $18 a share, what are our other options for protecting our position? Well, we could buy the same number of options at the July 17.5 put options at 60 cents, or we could buy something a little bit more conservative. Let's say the scenario based on our analyze tab is not acceptable to us. We're not willing to lose $1,110 if the shares of Starbucks declined. Yes, we like the upside potential, but we're not willing to take the risk of $1,000 if the stock were to decline before the expiration of the July options. In order to protect our stock at a more conservative rate, we would have to raise the strike price. In other words, we'd have to go a little bit deeper or closer to the money. Now remember, in the July options, there was not an $18 strike price, so we can't use that one. The next strike price that we'd have to go to is the $19 option. The $19 option would cost us $1.42. Now that's quite a bit more cost and protection. In fact, if we go back and take a look at this, if we go to the $19 strike price for the July options, it's going to cost us $1.42 times 10 contracts is $1,420. That's quite a bit of insurance to pay, even though it is 36 days out. But what does that do to our analysis tab? Well, in our analysis now, our maximum loss on this position is only $440, and it still relatively remains our upside potential intact. We don't make as much on the upside potential. Now, without the insurance, remember, we make about $2,000 for a 2-point move up in the stock, but we also lose $2,000. With our insurance, even though it costs us $1,400, we still have $1,000 of upside potential if it moves up $2. But our maximum loss at $2 down is only $410. So it does limit our risk quite a bit. Our maximum risk on the entire trade, and it doesn't matter how low the stock goes. Let's say we wake up tomorrow morning and Starbucks is trading at $5 a share. Our maximum loss is still only $440. So the amount of risk that you take in a stock is really dependent upon how much risk you want to take. Let's take another scenario. Let's say you're very aggressive and you think that there's no way that Starbucks is going to drop back down to, let's see where it was. I mean, it was down to as low as $15.50. So you agree with the idea that, having insurance on your stock in the form of purchasing a put option is a good idea, but you're very aggressive on the stock and you think that it's not going to go down to $15. So you buy, let's take a look at our trade tab again, and we'll only look at the July options, and we'll take a look at those $15 strike price options. We only want catastrophic insurance on our stock. In other words, if it opens up $5 lower and it's trading at around $14 or $12.50, then our $15 put options should be worth at least $1, $1.50. But what does that do to our profit and risk and reward analysis here? Well, if we drop down and we go down to the $15 strike price, it's only going to cost us 10 cents. That's not a bad deal. 10 cents of insurance would cost us on 10 contracts, which is equal to 1,000 shares of stock. It would only cost us $115. That's a relatively inexpensive insurance policy. But if we look at our analysis tab, our maximum risk has now jumped from $440 to $3,110. That's even worse than the 17.5 strike price that we had analyzed in the beginning. Yes, our upside potential is intact because we could gain $1,900, which is almost the full amount, even if we didn't have the insurance. If we took the insurance off, we'd have a $1,990 profit on a $2 move up in the stock. But if we added the insurance, our upside potential is only reduced by about $95 or $90. So the upside potential remains intact. However, if we took a look at the downside, if the stock does drop by $2, we'll lose $1,670. So the selection of the insurance that you provide on your stock is really determined based on the amount of risk that you really want to take. Now here's something that nobody else is going to tell you. My position when I take these positions, okay, and I actually did take a position in Starbucks. I took a position right around in here. There was like 3 or 4 days where the stock wasn't really going anywhere, and it seemed to hit some sort of bottom here. I looked at this high spike of volume on this day in which Starbucks actually, closed the day before at $17.85, and if you woke up the next day, it's trading at $16. That was a pretty dramatic drop in the stock right there. And people who bought it on that day, the day before, for $17.75, saw it trading the next day at $16. Probably got pretty spooked, especially if they had a fairly large position. Well, I saw that very large volume spike, and generally the large volume spikes like back here and here and here, and then eventually when the stock started railing a little bit and started coming back down, you could see that the volume on the sale side started drying up dramatically. Each day that the stock continued to decline, there was a little bit more volume, but nothing even close to this kind of volume here, or this volume here, or this volume here, in which days and days and days of high selling volume were indicated by these red bars. It seemed to have, pretty much dissipated. So a lot of the sellers probably got out at this point, and there weren't too many sellers left. People who were holding either the stock for long term or purchased on this day were eager to hold it and weren't really aggressive sellers at this point. Once that aggressive selling had started to decline, I felt it was a low-risk opportunity to start purchasing some shares. Even though volume on the upside did not really materialize, every time the stock declined slightly, especially on these 2 days here, declining volume, these 2 red bars down here, were extremely low. Right in there. These 2 days of very low volume on a day in which the stock declined indicated to me that the selling had pretty much dried up. Now remember, I had been watching this stock for quite some time. In fact, I started watching it back in here, back in July and August of last year. I began to look at the stock when it was really quite volatile here, but there was still a good amount of selling going on. I took a look in particular at this day here. I noticed that the selling was quite large. So what I was looking for is a time in which the stock would come back down to those levels on some selling pressure and price pressure on lower and lower volume. There were some days here in which volume was extremely low. However, there were other days in which there was extremely high volumes of selling. So I decided to wait on the stock. I also didn't see a very good pickup compared to the amount that was being sold on the days in which it was increasing. In fact, during this increase in price here and this decrease here, there was actually selling pressure that was higher than the day before in which there was buying pressure. In fact, as it declined here, the selling continued to increase. You can see that volume increased at a time when the stock was decreasing, and that's generally not a good sign. So I continued to watch the stock. As the stock continued to trade, it traded lower and lower on increasing volume. And that is generally not a good sign. Volume continued to increase as the stock declined. Once again, if I took a good look at, hold on a second. Let me get back to that. if I took a good look at the trend here, it would indicate that in fact selling has increased each time the stock decreased. And that only indicated to me that additional selling pressure would be forthcoming and additional pressure on the downside would be coming. Until it got to the point where here it looked like even though we had one large day here of downward pressure and quite a large spike in volume, during this time there didn't seem to be a lot of pressure on the stock as it declined in price. It wasn't until this capitulation volume right here that occurred, which I always look for. I always look for this capitulation. This is really a climatic selling point in the stock because it's actually larger than any previous of the previous selling days. You can go back all the way to August even of 2006 when we had this large decline in the stock. It was even larger than that. So a lot of the people who were hoping that the stock would advance here, and go back up to the point at which in which they bought the stock, so they could sell it and remain whole, that never happened. And I think people, once they saw the stock drop from this level and gap lower by a couple bucks, they realized that, hey, there's no more hope left for Starbucks, so I'm getting out. So that was the huge amount of volume here that I was looking for. After that happens, then I start to look for a spot in which I could take a position. And I actually purchased the stock right here. And shortly after that, the stock started trading up. Now, did I buy protection? Yes, I did. My point of this analysis is to give you an idea of how to evaluate not only a potential timing point of entering a stock position, but also giving you an idea of how I would have traded this. Generally, what I like to do is let the stock prove itself. In other words, I would have purchased a much better position. If I was to purchase Starbucks now, I would want to purchase the higher insurance policy that limited my downside risk to $430. If the stock proves itself, and it does increase in price, yes, my upside potential is somewhat limited. However, I still make a profit, don't I? My downside risk is, in fact, limited to just $430. And that's an acceptable risk based on an $18,000 stock purchase. What I'm looking for here is for the stock to prove that it will continue to increase in price. If I looked at the chart and I said, okay, well, I think my purchase at this point is probably a good idea because we do have a nice increasing we do have an increase in the price in the shares of the stock from a low of around $15.50 all the way up to $18.50. And since there's a little pullback here, it might be a good opportunity to enter into the stock. If I was thinking that. I'm not thinking that at this point because the volume on the up days is pretty low. I mean, you still have a couple of good up days. You've got higher volume on the up days than you do the selling days, the red bars. So it may be an attractive opportunity. I'm not suggesting that you go out and buy Starbucks stocks. I'm simply giving you an example of what I would be thinking as I analyze the stock and analyze my risk and reward in this position. So what I want to do is I want to be able to purchase 1,000 shares of Starbucks stock, pay the $1,400 in insurance to hold this stock, limiting my downside risk to just $430 until July. Remember, this option, the 10 contracts that we're going to buy as protection for this position, will expire in July. So, what happens at that time? Well, we'll talk about that. Here's another analysis. I'm buying the $19 put, which gives me a total risk of $430 until the third week in July, the third Friday in July, in which this option expires. If I were to purchase another option, let's say I went to the $20 put option on this, now my downside risk is only $200. Of course, my upside potential is greatly reduced. However, I only have $200 of risk in an $18,000 purchase. If I went even higher, now my risk is only $160. But again, my upside risk, my upside potential is also extremely limited. Where you buy your put is up to you. Whatever you feel comfortable with. I feel comfortable with a $400 loss on the stock. And I'll explain to you another reason why I feel comfortable with that. On an $18,000 purchase, if I lost $430, I'd be okay. It would not bother me. But here's where it gets really interesting. In order to demonstrate exactly what I'm talking about here, we have to go to the Think Back page for just a second. The Think Back analysis tool in Thinkorswim allows you to take a look at what option prices sold for at a time in the past. So let's take a look at what Starbucks, let's take a look at their chart just for a second again here. And let's say you are one of those enthusiastic people who purchased Starbucks stocks back here for $40 on November 16th, 2006. Now tell me the truth. If you saw only, let's see, now I gotta do this. If you saw only this part of the chart, what would you think about this stock? You think, hey, this thing is going up. This could be going up for quite some time. So let's go back to November 16th, 2006 in our Think Back tab. Let's call up the Starbucks symbol. Let's change the date to November 16th, 2006. At that time, we had the November options, which only had 1 day left. We had the December options, which had 29 days left. All right, well, let's take a look at the December options because it still had 29 days left. At that time, if you were to purchase the Starbucks stock at $39.43, you could have purchased the 37.5 strike priced options, the put options, for 90 cents. So 1,000 shares would have cost you $39,000. The insurance would have cost you 90 cents a contract times 10, which would have been times 100, which is the multiplier, which would have cost you $900. So we just go up to 10 shares, to 10 contracts. Okay. So at that time, the 37.5 would have cost you $900. That would have provided you with some protection at least. You would have still have lost the difference between the strike price and the price of the stock, which was $39.43 minus $37.50. Your maximum risk on this trade would have been approximately $2,500. That was probably not an acceptable risk to me. It may have been to you. I probably would have purchased the $40 put, which was a little bit more expensive at $1.90. Now that would have cost me $1,900 in order to protect those that stock. However, that stock cost me $40,000. So $1,900 of insurance would have been a little bit more expensive. However, let's see what would have happened the very next day. And remember, I'm buying this option here. They put the mid price in here, which I may have been able to get for $1.85. Let's see what happened the very next day. The very next day, the market opened, and let's see, I think I gotta bump up this date here. There we go. The 40 options that we purchased for $1.85 are now worth $2.90. If we take a look back here again, let's bump it up one day. The stock opened up down here at $37. If we continued, you would have seen the stock continue to decline until it hit $29. I'm sorry, we're over here. Would hit $35 just a few days later. Remember, we purchased the stock here at $39.43, which was at the close, and by December 1st, this is December 1st right here, it would have been trading at close to $35.25. So let's see what would have happened to our $40 put on December 1st. On December 1st, our $40 put would have risen in price to $4.90. Actually, we could have sold it for $4.80. Now remember that on the 16th, we purchased the option for $1.80. Well, at that time, no, I'm sorry. I'm not sure that's true. Let's go back to the 16th here for a second. Yeah, on the 16th, we bought it for $1.85. And we fast forward to December 1st, it was worth $4.80. That's approximately a $3 difference. How much did we lose in the stock? Well, the stock went from $39.43 down to $35. That's about a $4,000 loss. However, we gained a little bit, almost $3,000 in the price of our put option. Now at that time, I'm sorry, we're actually in December. Our $40 put option was actually $4. We could have gotten $4.80, so about the same price. So we would have made close to $3,000 on our put option because we bought the December 40 puts. Now, if we bought that would have given us $3,000 in protection on the downside of a stock that just dropped $4,000. So we still would have had a loss on the stock, but we would have gained $3,000 on the put option. Let's say we bought the 37.5 put, which was cheaper at 85 cents. With that $37.50 put option now is $2, and we could have sold it for $2.30. That's a difference of only $1.50. So we would have only had $1,500 in protection on the downside on a stock that dropped $4,000. The idea is to select the strike price on the put side for protection as insurance on your position in which you feel comfortable. My goal when I'm purchasing stock initially, this is on my opening position. If I were to purchase this stock at $40, I would want to have the stock prove itself and limit my initial risk to less than $500 generally. Now let's do the opposite. Let's say that we actually decided to purchase the stock. Let's go back to our current positions here. And let's say, like I did, I purchased the stock right around $16. And this was on May 13th. So let's go to May 13th, 2008. And the options that we had available were the June options. And I purchased, the stock was trading at $15.95 at the time. I bought it for $16. And I purchased a slightly in the money put option at $16. In other words, I felt that the downside risk of the potential of the stock was pretty low. But however, I didn't buy a lower strike price. I bought the strike price. I bought the put option as insurance at the same strike price as the stock. In other words, if my stock went down, if I bought it at $16 and I bought the $16 put, if it went down to $15, I would have gotten paid $1,000. That put option would be worth $1,000 minus what I paid for it. So I only would have lost the 68 cents that I would have purchased it for, or approximately $680. Do you see why that is the case? Because if the stock falls $1, I lose $1,000 on the shares of the stock, but I gain 42 cents because that $16 put now will be worth $1 if the stock drops to $15. So I've made a $420 profit on that. However, I paid 68 cents for it, so that's my maximum risk. So my maximum risk was $68 or $680 on the stock. Even if it fell to $14, I still would have had a maximum loss of $680 on the stock. Now, as we advance, the price of the put option declined. However, the price of the stock increased. Now my $16 puts are only worth 25 cents. I lost $400 because I paid 68 cents for these. I lost approximately $65 or $650 on this particular option. However, since I purchased the stock at $16, I made $1,000 on the price of the shares of the stock. So I made money. I let the stock prove itself. In other words, when I opened the position, I wanted as much protection as I possibly could get. As the stock advanced in price, advanced in price, my option, the $16 put, declined dramatically. However, I made $2,033 on the $2,333 on the stock, but I lost because my $16 put option now is only worth about 5 cents if I wanted to sell it. So I lost approximately 63 cents or $630 on the put option, my insurance. At this point, since the price of the stock is farther above my strike price here, I still have a $2 limited. I still have a $2 potential loss or $2,000 potential loss in the stock if the stock went back to $16. Since I lost approximately $630 in the stock, but I have a $2,333 profit in this. I'm sorry, if I lost $630 in this put option, and I have a $2,333 profit in the stock, that still leaves me with approximately $1,500 in profit, closer to $1,800 in profit. I took some of the $1,800 in profit to purchase additional protection. I still have these 10 $16 put options. However, at the time, I also purchased another 5 of these $18 put options as additional insurance, which cost me an additional $200. That $200 came out of my profits. So not only did I lose 63 cents here, but I purchased another insurance policy at a higher strike price for an additional $200. That's $800 in cost for my insurance. I still have a profit of approximately $1,500 on the increase in the shares of the Starbucks stock. as we get closer to expiration, what I would do is if the stock continued to increase in price, I would roll over the put options that I have available here and roll them into the next month's strike price, into the next month's options. Put options is insurance. Now, depending on where the stock is, I would either go a little bit lower, because remember, now I have some built-in profit. I have approximately $2,333 in profit at this time. I don't need as much protection now because I do have a cushion of profit in the stock. So I could now sell these I have 10 of these $16 put options. I could sell those excuse me, and purchase an additional 10 of these $16 put options for 17 cents. It would cost me an additional $120. However, I've also got additional protection because now I'm 50 days out in protection. I could also purchase 10 of the 1750 strike price options, which would give me even more additional protection on the downside risk of my stock. Because at that point, it's almost like I have locked in the profits minus about $1, because as the price of the stock goes up, I can also continue to roll up my protection underneath that to lock in the profits that I have. After the stock has proven itself, it's up $2.33 from where I purchased it, I would not be so inclined to purchase an in-the-money put option in order to limit my downside risk at this point. I would certainly roll up the strike prices of my puts to be a little bit closer to the money. For example, a $17.50 put would be a much more attractive option to me because of the lower cost. But I would not do that initially because my potential exposure to the downside on a brand new position is much larger. So I would want the stock to have a lower risk on the initial position if it did decline on me. So I would have a maximum loss here of only $440. The stock has proven itself and moved up, so now I can roll up my strike prices, but I also don't have to go as deep in the money. I can go at the 1750 level and still have enough protection at a lower cost as the stock continued to increase. Now, as the stock increased, let's say we go out to October. If the stock was, at a decent level, so if it was above $25 or it continued to rise in price, I would continue to roll up my put options each and every month that I held this position. And you might be asking yourself, well, why would you continue to purchase insurance on the stock if, in fact, it has gone from $16 to, let's say, $25? You have a fairly large profit in the stock already. Why would you continue to roll up your puts? Because I do not use stop losses. And here's the reason. Let's go back to our Starbucks stock just for a second again. Let's say you purchased Starbucks stock right here. On this particular day, it was selling for you could have easily purchased it between $17.70 and $17.85. Now, if you purchased the stock at that point and you said, okay, well, you know what I'm going to do? I'm going to send a stop loss on the stock, and I'm going to have it held with my brokerage company so that I want it to be sold at the low of this previous bar, which was $17.40. So you set a stop loss, and you had absolutely no other type of protection. You didn't have any of the put options that we were discussing. Well, to your surprise, the very next day, the stock opens at $15, approximately $16. Your stop loss order was transferred to a market order, and your stock was sold rather than at the price that you determined would be your stop loss at $17.40. It was actually sold at $16 at the opening price of the stock. Your stop loss was triggered. It turned into a market order. and now you've sold out your entire position at $16, much lower, $1.40 lower than you had anticipated. You had an immediate loss on your position. Your stop loss was ineffective because it did not limit your downside protection to $17.40. That's why I don't use stop loss orders. Overnight news, other events, especially when they come out with the earnings announcements or some other announcement, can dramatically affect the price of the stock, and stop loss orders will not help you if the stock gaps down. That's why I generally do not use stop losses. Instead, I like to use put options for insurance. Yes, it does cost something. It's not free insurance like a stop loss order would be. However, how much did that stop loss order really protect you and really cost you? It cost you a lot more. If you bought 1,000 shares of stock at $17.80 and you got stopped out at $16 on 1,000 shares of stock, that stop loss order cost you $1,780. A put position, on the other hand, maybe if I had limited my loss, if I initiated the position on this day, my maximum loss on that position would have been $440. And in fact, what I'll do is I'm going to show you the reason that I can enter a trade for $14,000 and turn it into $75,000 in 8 months is because when I initiated this position, it was for the long term. I placed a put option. If I was to initiate this position, I would put a put option in place as insurance with a very, very tight loss of only $400 like I did and I analyzed here. I would have purchased an in-the-money put option just slightly above the current price of the stock, and once the stock dropped and I would have made $1,780, well, that $1,780 would have allowed me to purchase additional shares of the stock. That's right. This is where the majority of investors who simply use covered positions, and this is technically called covered stock because you're buying the stock and protecting it with a put option. And at this point, I would have purchased additional shares using, well, it's over here, but you can see what I mean. I would have purchased additional shares of the stock at $17. I would have cashed in my insurance policy. Now my put that I purchased when I initiated this position would have given me approximately a $1,700 profit. Well, a $1,700 profit divided by a share price of $15.90, say, oops, I got it backwards, 1780, and the profit on my put position divided by a share price of $15.90 would have allowed me to purchase an additional 110 shares of stock. However, I probably would have purchased an additional 100 shares of stock at this point, cashed in my insurance policy. So at this point, I would have had 1,100 shares of stock, and then I would have used the additional cash, another 11 shares or approximately $300 now, to purchase another put option instead of buying maybe the $18 put option here, which would have given me that $1,780 profit. I cash that in. I buy an additional 100 shares of stock. Now I have 1,100 shares of stock. and I would have purchased an additional put option as protection at the $16 level, which was just right at the money, as insurance. Now let's see what a $16 put option would have cost me on this particular day. This was April 24th, 2008. So with the stock trading at $15.99, I would have purchased an additional 100 shares of stock at $15.99, and I could have purchased either the $15 or the $16 strike price put option, and I could have paid approximately 67 cents for the $15 strike price, or $16 strike price at $1.07. I probably would have gone with the here's a good analysis here. Now I have 1,100 shares of stock. At 1,100 shares of stock, now I need to purchase 11 contracts in order to protect those shares of 1,100 shares of stock. I'm not happy with either of these options. If the stock is trading for $15.99, if I purchased the $16 strike price, it would have cost me approximately $1,000, almost $1,100. Let's see, if we go up to 1,100, 11 contracts, that would have cost me approximately times $1.06 times the multiplier of 100, $1,166. I would rather have purchased the $15.50 strike price. But the $15.50 strike price is not available. Since the $15.50 strike price is not available, I could have created a synthetic strike price of $15.50 by simply purchasing, instead of 11 contracts at the $16 strike price, let's get rid of this one because that's the old one. I could have purchased a combination of the $16 and $15 strike prices. In other words, I would create a synthetic insurance policy at a synthetic strike price of $15.50 by, let's say, purchasing 6 of the $16 puts and 5 of the $15 puts. That would have essentially given me a synthetic strike price of $15.50. Do you see that? Because if I split, since I have now 1,100 shares of stock, I have, and I wanted to get the I wanted to purchase the $15.50 strike price, but there isn't one. So all I had to do was split the number of contracts between the $16 and the $15 strike prices. Let's go back to our chart for a second. At this point, I would have seen 2 days of lower prices, and the price would have gone down to about $15.60. Not enough of a price movement to really cash in any insurance policy here, but now I do have 1,100 shares of stock. Remember, I lost approximately, maybe $400. Remember, my maximum loss on initiating position is $500. At least that's where I feel comfortable on 1,000 shares of stock. I cashed in my insurance policy. I purchased additional puts as insurance, and now I have 1,100 shares of stock. At 15, I have some at because I lost $500 on this. Now my cost basis is a little bit different. However, I have 1,100 shares of stock at $15.90. I have additional put protection, and I only have a $400 loss at this point. Now let's follow the stock as it goes along. It never really falls below the low of this bar, and it just continues to go up at this point all the way up to $18. Let's pick these 3 particular days in particular. It goes up to $18.30, and at that point, since I have 1,100 shares and I bought it at $15.90 and it goes up to $18.30, let's see what kind of a profit potential that is. From $15.90 minus $18.30 is $2.04. We're going to multiply that by 1,100 shares, because that's how many shares of stock I have now. That's a gain of $2,640. Now remember, I lost $400, let's say $450, just to be fair on this. So I will subtract, that's 26.40, we got to put everything in positive here. I'll subtract the $450 that I lost on my initial position, and I would have purchased 6 of these for approximately $600 in protection, and 5 of these for approximately $300 in protection. That's $900 in additional protection on the stock in the form of put options, leaving me with a profit of $1,290, in which the stock only rose from the $17.90 that I purchased it to $18.30. That's only 40 cents. Do you see that? I purchased the stock here. It dropped here. I cashed in my insurance policy, bought additional shares of the stock. It rose up, and now I've sold it here. For $18.30, which is only 40 cents above where I purchased it, but I made $1,290. Do you see how powerful this strategy is? Now, I could have sold it at that point and retained my $1,290. However, in most cases, what I'm interested in is dealing with the stock over a longer period of time. As the stock moves higher, I would now also sell my existing puts, and using some of the profits of a higher position in the stock, using that to purchase additional puts. Sometimes, in most of the cases, if the position starts out badly like this one did, I would use the insurance policy by cashing it in to purchase additional shares of stock every time this dropped. I could have done this a number of different times, actually. I could have purchased an insurance policy here by buying the puts, have it run up, sold the puts I had here to buy additional puts here, let the stock run down, cash in my insurance policy, buy another 40, 50 shares of stock, buy some additional put options, let the stock run up, purchase additional put options if the stock fell down again, and so forth, all the way up until I reached a higher level. However, in many cases in which the stock had fallen dramatically and you purchased additional shares of stock at a lower level, a lot of times what I'll do is I'll feel that the stock has failed to perform, and I will wait for that additional rise in price and then cash out at a $1,290 profit, and then go look for a different stock that has greater potential on the upside. But the idea is to use your insurance policy that you purchased on the puts in order to purchase additional shares of stock at a lower level if the stock does drop. That is something that generally only professionals do, but now you have the knowledge as well on how to do this. You may have read in other investment books about dollar cost averaging. For example, let's say you were purchasing stock back here when the stock was at $26. If we go back to, this level right up in here, let's say you purchased the stock here. Well, dollar cost averaging would mean that not only would you purchase the stock here, but as the stock dropped, you would purchase additional shares, and that means putting more money out of your pocket. In this case, we invested $17,900 in the purchase of the stock, but we used our insurance policy to purchase additional shares of the stock when the stock dropped. We did not take any more money out of our pocket in order to purchase those additional shares or the insurance. Here, if you were to do traditional dollar cost averaging, means that you would purchase additional shares of stock out of your pocket in order to increase the number of shares that you were purchasing, but that would be a really horrible plan. As the stock continued to drop, you'd continue to buy more and more shares with more money out of your pocket, which would cost you many thousands of dollars. If I was to purchase shares of the stock at $26, I had an insurance policy. Remember, I like to have it very, very tight on initiating positions. My maximum loss is only going to be between $400 and $500. At that point, I probably would have bought something like the $27 or $26.50 strike price puts. And then as the stock dropped down to $22.50, I would have been able to cash in a $4,000 policy at that point, use some of that to buy some additional protection, and use the rest to buy additional shares of the stock. So that's the difference between this type of a strategy and dollar cost averaging. This is a truly dynamic way to trade because your insurance policy, the puts that you put into place when you initiate a position, allows you, if the stock does drop, to purchase additional shares of the stock. When the stock does eventually increase in price, you could have purchased insurance policies all the way down during this decline. Let's say you started with an initial position of 1,000 shares. By the time it reached $17 a share, you could have had, instead of 1,000 shares of the stock, you could have had 3,000 shares of the stock with the additional cashing in of the put options that you had as insurance. Now at 3,000 shares of the stock at $17 and it rallies up to $18.50, now you're making close to $4,500 in profits just from a small rally in the stock with no extra cash out of your pocket whatsoever. And if a strike price was not available in which you felt comfortable with your insurance position, you could have created, as I mentioned here, a synthetic strike price by splitting the number of put options that you were going to purchase on the way down. This is truly a dynamic way to generate spectacular returns in the market. And it's actually a way for you to increase dramatically the amount of profits that you'd be able to create. Let's take a look at Cisco for a second. Imagine purchasing the stock for Cisco up $29 back here in the beginning of 2004, only to see the stock dramatically decrease in price down to $16.50. Without insurance, you would have lost approximately $12.50 a share. But with insurance, you could have cashed in those policies every time it went through your strike price before expiration, cash in those policies, purchase new puts, and all the while using your put insurance to accumulate additional shares of the stock. Then once it gets down to this point here, you would have had maybe started out with 1,000 shares of stock. By the time it reached this point, you would have had maybe 2,000 shares of stock, and then seen a dramatic rise in price all the way back up to $29. Your insurance would have actually helped you accumulate additional shares. At $17 to $29, that's a $12 increase in price. On 2,000 shares of stock, that's approximately $24,000 in profits. and your initial cost was only $29,000 for the initial 1,000 shares of the stock here. You see how powerful that is? And you would have gotten to the point where, I mean, the stock was at the exact same level that you purchased it, you know, back here in the beginning of 2004, and then 2007, you're back up to $29, but instead of, you know, you would have made a $24,000 profit on your $29,000 investment. Yeah, it would have taken you a couple years to get back up to that level, but if you just purchased 29,000 shares of stock without any type of protection, without any put protection whatsoever, no insurance policy on the stock at all, you would have seen only a break even on this position. You would have had to wait 3 years just to break even instead of making a $24,000 profit. Here's another stock. I told you about the Starbucks stock that I did recently, but I also took a position recently in Activision. Activision, I looked at the stock. It looked like a fairly erratic stock that was moving up, but right in this period here, it was just doing absolutely nothing. And I initiated a position right in here when I could see that there were larger dark bars here. Looks like there was a very light accumulation of the stock in this period, and I purchased the stock right in here, right around $27.24. Well, I didn't have to wait too long, maybe about a week, week and a half, before the stock just absolutely took off and skyrocketed upwards. So if it had fallen, then I would have cashed into my insurance policy. I would have purchased additional shares of stock and held on to the stock because I believed in the stock. I believed that the long-term value of the stock would have increased in price. And that's the only kind of stock that you really want to put on in these types of positions. You want to be able to go in to buy stock that you believe in, that you believe has an absolute opportunity to increase in price. I would not have purchased the stock in this, at $27.25 if I didn't believe that it would have a future, good appreciation over the long term. Because even if the stock did break down and go back into this lower channel line, it would have given me the put that I had in place as insurance would have protected me. I would have only lost about $400, but I could have cashed in my put position in order to accumulate additional shares of stock. And then as the stock rose, instead of 1,000 shares of the stock, I would have had maybe 1,500 shares of the stock, and I would have made even more money on the future increase of the price of the stock. As it was, as the stock began to increase in price, then what I did was I simply rolled up my put position using the profits. I've already had profits built into the position, and I used those put options. I just simply cashed in my old put options and rolled up my existing put options. But now, because I have a good deal of profit, the stock did prove itself to be a good performing stock, I didn't have to have the put position as close as I used to have. In other words, let's say you bought Starbucks at $15. You've got a built-in profit here on the stock. You don't have to buy something that's in the money anymore. Now you can go down a little bit. You can go back down to the $16 strike price and buy those cheap options, but only after it's proven itself and moved up in price. This is the way professional traders make money in stocks, whether they go up or down. Because if they go down, all they do is cash in their put insurance policies to purchase additional shares of the stock. And if it goes up, they make money, and the insurance really didn't cost them that much, did it? On initiating positions, you want to make sure that you purchase something that you feel comfortable with. In my case, I'm comfortable with a $400 loss in this position, and I would purchase this stock with the put option as protection. I would have a maximum loss of $400. I don't care where the stock went. This put option would increase in value. I would cash it in to buy more shares of the stock because I believe in this stock. I believe it has future upside potential. I'm not talking specifically about Starbucks, but let's say any stock that you were interested in purchasing. Here are some of the stocks that I've been looking at lately. I've been looking at SWN as a short position, actually. I've been looking at Urban, ADSK, Netflix, WDC, Starbucks, and a couple of indices. Now, can you do this with indices? Yes, you can. Let's say you thought there was a really good potential for the home builders, home builders ETF, HXB, which is the home builders. They've gotten decimated. I mean, they've gotten absolutely killed with the credit crunch and the problems with home prices in the last few years here in the market. You could do the same thing as long as there are options trading on a particular ETF. This is an ETF. It's a SPDR ETF. You could do the same thing. You could purchase put options on this ETF, which is currently trading at $18.13, and you could purchase the $18 or even the $19 in the money put option as insurance. Now let me just show you something else, because the TOS platform does make this extremely easy. What it doesn't tell you is how to adjust these positions, which I just went through an exhaustive detailed study of. You go to buy covered stock. It automatically brings up the stock with the strike price at which you just selected. If you wanted to purchase 700 shares or 600 shares, it would automatically calculate the number of put options that you need to purchase. The important thing is to analyze the trade. You want to go over and analyze the trade so that you know exactly what your maximum loss is on the trade when you initiate it. On 1,000 shares, my maximum loss here would be $790. I'm not particularly happy with that. I might go to the $20. At $20, my maximum, the $20 put would give me a maximum loss of $500. That's only when I initiate a position. If this it does cost a little bit more when you initiate a position, but guess what? Let's go back to the chart again. If XHB does increase in price and it goes back, let's say it goes up to like the 21 level. Well, at the 21 level, I have approximately, let's say if I was doing 1,000 shares, at the 21 level, I have $3,000 in profit. Okay, it cost me $2,400 for my insurance, but now that I have a $3,000 profit locked into my stock position, my ETF position, now when I go to roll over my put position, because the stock has already proven itself, well, maybe now I can go down to the $18 level or the $20 level at that time, which would be a little bit cheaper. I can purchase a put option as insurance slightly under the market because I already have a profitable position built into it. However, this is not an attractive proposition for me. I'm not recommending HSB, and I would not do this for one reason. The volatility level of this particular stock is 50%. That is way, way too high. That's much higher than I would feel comfortable doing. If we took a look at the XLF, which is another ETF that I'm taking a look at, that has a volatility level of 43%. Why is that important? Well, it's important because the higher the volatility level, this is not the delta. The delta is this column here in yellow. The volatility level here is the numbers that I'm looking at. This volatility at 43% affects the value and affects the price of the options, especially the put options that you're buying. It increases the price of the options. So in other words, you're paying a huge premium in order to protect your investment here. And I would not pay that much in order to protect this investment. I would look for other opportunities. Let's take a look at a stock that has been going up recently. Just as an example. Let's take a look at Netflix. Netflix has had a pretty good run. It dropped off a little bit, but it's starting to kind of stabilize here in this area. Let's say I had a I have a really good idea that Netflix is going to increase in price here. Let's take a look at the volatility for Netflix. Volatility for Netflix is still pretty high. That's 53%. That's a little bit too high for me. Let's take a look at another stock. Let's go to Urban Outfitters. Urban Outfitters is another stock that's been, increasing dramatically in price. It's fluctuated pretty good in here, but it has on the whole generally increased in price pretty good. Let's take a look at the volatility of Netflix. Netflix again, volatility is up around 45%. Now that may be the result of the market as a whole declining. I don't know, but those are pretty high volatility levels. Let's take a look at something like the Qs. Now you could do this on an index like I mentioned. Now the Qs, the volatility level is only 26%. Well, that's a little bit more manageable. At this point, you could buy a July option which has a 26% volatility level at the money for about $1.23. Let's just analyze this just for a second. I want to show you that volatility does actually increase the price of options. Here we have the July 47 put. Now if we were to purchase this as protection and the volatility level is at 26%, let's see what happens when we adjust the volatility and volatility goes higher. You can see that as volatility increases, the profit and loss will increase dramatically as well. So if we adjust the volatility back to 0 point, so volatility is currently at 26.03% for that particular option, we can see that we have a loss of $1.22 on that option. If volatility were to increase by 1 percentage point, now we have a profit of $4.32 on that one option. So the volatility will increase the profit potential of that particular option. However, if you buy an option with an extremely high volatility level, on initiating and the volatility were to come down, you would lose money on that option. That's why it's important to understand that when you're purchasing options for particular stocks as protection on a put position, you want to try to purchase your put options, your insurance, at a lower volatility level. You don't want to purchase them at the 50% level, which is, depending on the stock, could be high or low, but generally a 50% level is pretty high. Let's take a look at the volatility for Starbucks now. Generally, if the market has come down, if the stock has come down dramatically, the price of the volatility of those particular options will also increase in price. The volatility will also increase. Let's take a look at Apple. Let's see what the volatility level of Apple is. Even Apple is at 48%. If we take a look at Apple, unless it's come down recently, yeah, it has. It's come down a little bit here. In fact, it's down quite a bit today. Maybe that's why there's an increase in the volatility levels. The volatility levels would have been a little bit lower up here. Now they're at 48%, which is pretty high because Apple is down over $6 today. So volatility levels do have a dramatic influence on the price of particular option prices and stocks. So you generally want to buy put protection based on a lower volatility, and the only way that you can do that is by purchasing stocks that have already have already been increasing in price. And generally, if it's increasing price, there's a good reason for that. And you generally want to buy stocks that look like they're going up anyway. Okay, there's one last component to this type of a system that I wanted to talk to you about because the profits can really be dramatic. Let's take Apple for a second. If you were to purchase Apple up here at $200 a share, I think you'd be really disappointed to see the stock drop dramatically here down into the 120s level. It's an $80 a share decrease in the price. If you didn't purchase your put protection up here, you would have gotten decimated in this stock. Just think about it for a second. 1,000 shares of Apple at $200 a share is a $200,000 investment. If you had no protection on that, I mean, that's the price of a house in some small communities. So you'd be very foolish not to have some sort of insurance protection. And that's what put options really are when you combine them with the purchase of stock. It's insurance. If you purchased put options here on 1,000 shares of Apple stock, you would have gotten, instead of losing $80,000 on your investment, you would have made close to $79,000 on your put options without any additional money. You could have used that $79,000 then. Let's take $79,000. Let's say you purchased an at-the-money put option as insurance and protection for the $200,000 in shares price of the purchase that you just made of 1,000 shares of Apple at $200 a share. And it dropped by, went down to this 120 level, and you decided to cash in your insurance. Well, you would have made close to $80 on the put option that you purchased. At 10 times 80, it's $80,000. Let's say you had a maximum loss of $1,000, because this is a pretty expensive stock. You would have cashed in that put insurance premium, put insurance for $79,000. How many shares of stock could you have purchased additional at this 120? Let's say the 125 level. Well, let's take $79,000 divided by $125. You would have purchased an additional 632 shares. Now, instead of having 1,000 shares at this 125 level, you would have had 1,632 shares. Now, okay, you lost $1,000 because you were smart enough to buy insurance when the stock declined. When the stock got down to 25, you said, okay, I'm going to cash in my insurance policy. I'm going to buy $632 more shares. That's rounded off to 1,600 shares. And you use the other 32 shares to buy additional put insurance, so there's no additional out-of-pocket expenses to hold these 1,000 shares of Apple. Well, at the 125 level, the stock started to stabilize, and it ran all the way up to, let's say, we didn't get out at the top. We didn't get out at 190. We got out at 185. We had plenty of opportunity to sell the stock at 185. Well, now because we have 1,600 shares at 185, the difference between 125 and 185 is $60 per share. We take the 1,600 shares that we have, because remember we started out with 1,000. We cashed in our insurance policy. We bought another 600. Used the other 32 shares to purchase more insurance, and it ran up another $60. Well, let's see where we would have come out. Let's multiply that by $60 a share, and we get a $96,000 of profit. Now, right here, we bought 1,000 shares at $200 a share equals $200,000. Right at 125, we cashed in our insurance policy and made $79,000 on our puts. At the same time, we purchased an additional 600 shares at $125 a share. Well, you know what I mean. Shares. I'll get this eventually. How do you spell share? It's been a long day. Okay. Okay. So, we purchased just under 600 shares, and our loss so far is only $1,000 because we had our insurance policy. So, the stock dropped $80 a share. We cashed in our insurance policy for $79,000. Our maximum loss is $1,000 so far. Now the stock runs back up to 185. We have 1,600 shares of stock because we added the 600 at 185. That equals a $96,000 profit. On 1,600 shares, and let's see, the stock ran up $60. So we started out with 1,000 shares. That's a $200,000 investment. Cashed in our insurance policy. We ran it up. We made a between 125 and 185 is $60 times 1,600 shares, and that was a $60 run up. Remember, in the price of the stock. Gives us a $96,000 profit minus the $1,000 that we lost. Minus our $1,000 loss equals a $95,000 profit. So you can see that even though we purchased the shares at $200 and we sold them at $185, we made a $95,000 profit based on the management of this trade when we had our put insurance, cashed it in, bought additional shares for the eventual run up in the price of the stock. That's how powerful this method of trading stocks is. Okay, guys, that's it for this particular module. In the next module, this is the method that I have used, and this is just an incredible way to trade when you understand the fact that you have insurance on your stock that you can cash in to buy additional shares, so when it goes back up, you can actually increase your profits. And this is, I mean, when you make a purchase of a $200 stock, and it only goes to 185, and you make a $95,000 profit. That's pretty powerful. Stay tuned for the next explosive strategy. I think you're really going to be interested in this and how to buy stocks at a very, very cheap price. And you know what? If the market doesn't cooperate, I get paid lots of money for just waiting around. All right? So stay tuned for that. Trade with confidence.